I thought, why don't I just go out and ask 10 or 15 questions that I think would be the most important for someone to understand about the banking system. And I'll just go to 3 different AI models, and it'll give you an idea as to what the banking system is really about. And so this will give you the opportunity to see the question. Then you can go back to your favorite AI model, ask the same question, but this time tell it to go more in depth so that you can learn even more. Hope you enjoy this. The first question that I asked the AI models was, when I deposit money in a bank, do I retain legal ownership of that money, or does the bank own it? This is something a lot of people do not understand because they think a bank is their custodian and it's their money. Legal ownership. The bank owns your deposits. They become the bank's property when deposited. Legal relationship. Debtor-creditor. The bank equals the debtor, right? They owe you money. And you are the creditor. You lent money to the bank. Again, most people don't think that that's the relationship. The legal relationship is exactly what I'm telling you it is. You have put money into the bank. You have given them a loan, and they have a legal right to use that money any way they want. It is not yours any longer. They do not have a fiduciary responsibility. When you quote unquote deposit, and it really isn't a deposit, money into a bank, you're actually making an unsecured loan to the bank. Let me reiterate, these are the words exactly as Claude gave them to me. That's why I've got the question up there in the top 2. So you can go to Claude, you can go to ChatGPT, you can go to any AI model you want and look at these questions, see if you don't get the exact same answers. Okay, so this is Grok's answer. No, you do not retain legal ownership of the deposited money in a standard demand deposit account. That's a checking account or savings account. Ownership transfers. When you deposit cash or equivalent into a general bank account, the title of the money passes to the bank. How many of you knew that? Now the second question. Does a bank owe me fiduciary duties like a trustee would? No. A typical bank deposit does not create a fiduciary responsibility. That's ChatGPT. Okay? What a bank is, for normal deposits, a debtor. The bank owes you money, not a custodian, not a trustee, not a fiduciary. Let that sink in. The bank is not acting for and in behalf of you when you put money into that bank, not as a custodian, not as a trustee, not as a fiduciary. They own that money. You have just given them, as I just said, an unsecured loan. Okay, this is Claude. No, banks are not fiduciaries. Bank account agreements contain language that says, quote, opening account does not create a fiduciary responsibility. So it's not just that someone's interpreting it this way, they actually put that language into it. So go read your deposit contract that you made with Wells Fargo when you dumped your money in there. You'll see that that is in there. When I deposit money in a mutual insurance company, do I retain legal ownership of my cash value, or does the mutual company own it? And these answers are going to be coming from Claude. So Claude said, short answer, you own it. Legal ownership. You are the owner. The cash value is your property. Listed as your asset on your balance sheet. You have contractual ownership rights protected by state insurance laws as compared to federal. We'll explain that in just a second. And not subject to insurance company creditors. In other words, if the insurance company starts to go down, your cash value is still there. We'll see that in just a second because they have to keep it there. Okay? Now, this is the answer that Grok said. In a mutual company, when you pay premiums that build cash value, you, the policyholder/owner, retain legal ownership. You also get access to cash value via tax-free policy loans. We just saw that. You can borrow without repayment requirements. Keep in mind that the mutual life insurance company does not own your cash value. It holds and invests the funds to support your guaranteed cash value, your growth and death benefit. The insurer acts as a custodian manager, okay? That is very different than what we just saw with a bank. The bank doesn't act as your custodian or manager. But title and beneficial interest belongs to you. Why are insurance company deposits protected from confiscation and bank deposits are not under Title II of the Dodd-Frank Act? The bank deposit relationship. You are a creditor, not an owner. When you deposit money in a bank, the legal reality that most people don't understand is that you no longer own that money. The bank does. I know we've hit this home, and I'm going to continue to pound on it. Legally, you are a bank's quote-unquote unsecured general creditor. You hold a debt claim, essentially an IOU. Okay. This is why Congress, through Dodd-Frank's Title II, and it's called the Orderly Liquidation Authority, or you'll often hear it just called OLA by those that are talking about it, can restructure. Again, restructure is a euphemism for liquidation. So they can liquidate or bail in those debt claims. You are not having your property taken from you in a constitutional sense. Why? Because it was already taken when you deposited an unsecured loan to the bank, right? You're having a debt claim or deposit modification, which falls squarely within Congress's authority over commerce, banking, and insolvency law. All right, the mutual insurance relationship. And again, don't get this confused with a stock-based insurance company. This is only a mutual insurance company, and I don't work with stock-based companies. You're an owner, not a creditor. This is where the structural difference is profound. You're a member owner of the insurance company. The cash value and death benefit are not a debt claim the insurance company owes you. They represent your ownership interest and contractual property rights within a mutual structure. So if the term mutual insurance or mutual structure isn't familiar to you, what it's saying is kind of like a co-op or a fraternal organization, right? You are part of an organization that exists for and behalf of its owners and policyholders who are one in the same, okay? Policyholders collectively own the company, share in its surplus, and receive dividends. What matters constitutionally is what the contract actually conveys. With a bank deposit, a contract conveys a debt claim. We've talked about this. Congress can legislate around a debt claim with its commerce and banking powers. With a mutual life company, the contract conveys a property interest in an insurance company itself, guaranteed statutory reserve protection, and contractual rights that predate modern federal banking regulation. Now, I'd like to show you, if you're wondering what modern federal banking regulation is all about, I'm going to put you into a meeting here for a couple minutes, and you're going to listen to the FDIC discuss Title II of Dodd-Frank and how much information they think you deserve to hear, okay? So here it is, a modern federal banking regulation being discussed in public. You tell me, do they care about your interest as a depositor?
There are a lot of things we've been thinking about, and what we want to hear from you today is what you think the priorities would be in order to go about setting expectations appropriately in public about how we would execute Title II, so that if and when we do have to have that announcement on Friday night, ideally Friday night, that people are in a position to receive it, understand it, and say, yeah, that works. And we can see how this will happen. Of course, there will be doubters, but there's a lot of things going on. So with that,
I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis. And this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments. And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people who charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. and they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Okay, question number 3, still with Claude. On a bank's balance sheet, where do customer deposits appear? On the asset side or the liability? Customer deposits are liabilities for the bank. Okay, legal implications. If deposits were your property being held for you, they'd be off the balance sheet entirely. Like money put in a safe deposit box, right? You take grandma's diamond ring, right? And you put it in the safe deposit box. That's not something that goes on the bank's assets or liability side, right? It's just a box there and they're holding it as a custodian. Note, your money is on the bank's balance sheet as a liability. It's not off the balance sheet completely as it would be if they were actually just holding your, if they were just holding your deposits. Like a safe deposit box and its contents. I just said that. Okay, question number 4, and this again is with Claude. What is Title II of Dodd-Frank Act? What authority did it give the FDIC regarding bank failures and liquidations? If you want to look up the term, it's called OLA. That's what you'll hear them say in their meetings and such, but it means Orderly Liquidation Authority. Now, they're going to say receivership all the time, too. Remember, receivership is just a euphemism for liquidating a bank. Okay, so they have the Orderly Liquidation Authority. It's the legal framework to resolve too big to fail institutions. Okay, the new powers were given the FDIC in 2010. 1, authority over all major financial institutions. So what they call those is significantly important financial institutions, SIFI. Power to liquidate without bankruptcy court. Again, these are quotes from Claude. Authority to convert unsecured debts to equity. What does that mean? That means when they use their orderly liquidation authority, they'll announce it on Friday night. The FDIC will announce that they've become the receiver of a bank, or in other words, the liquidator of a bank. That bank will be put into not bankruptcy because they don't need it to be in bankruptcy. They will create a new entity. They will fire the old management over the weekend. They'll create a new entity. They'll wipe out all the debts, and then they're going to take, except, well, some of it, your unsecured debts, which again, we just showed that you are a creditor of the bank. And what they're going to do is they now have the authority to call your debt, all that money sitting there that depositors have put in there is theirs. They then take that money and they use it to save the banking institution, and then they give that money, they turn that money into equity. So Friday, they're going to close down the bank. Monday, you're going to wake up knowing that if you had $100,000 in there, you might have $50,000 worth of quote unquote equity in this new bank that they've just created. You lost 50% of the value of your deposit immediately, and they gave you $50,000 of worthless stock in a brand new bank that almost went bankrupt over the weekend. That's what legally happens with the FDIC, Orderly Liquidation Authority. English. Okay. Number 5, what is a bail-in versus a bailout? Here's what Claude had to say. Bailout, the old way, was pre-2010. External rescue, government or taxpayers. Bail-in, the new way, post-2010. Internal rescue, creditors and depositors. Title II gives FDIC legal authority to use deposits over $250,000 to absorb bank losses. All right, think about that for just a second. If you've got 250 or more sitting in a bank, it's probably because you're an entrepreneur. How many of you entrepreneurs have started a business and had it fail? My wife and I did. We bought a roller rink and it failed spectacularly, right? But who didn't come to bail me out? The federal government. They didn't say, oh, well, that little roller rink in Corvallis, Oregon is so important to that society that we're going to keep it alive. No, banks hold this special value, and we're going to talk about what that value is, and most people never talk about this either. We're going to talk about what makes banks so valuable to the U.S. economy that the federal government is willing to take your deposits and keep that organization alive in your community. I'll explain that in a minute, but that's a specialty that no other business has. Question number 6, what happened to bank depositors over 100,000 euro in Cyprus in March 2013? What percentage of their deposits did they lose? So this is what actually happened in 2013 in Cyprus. This is the answer from Claude. What happened? Cyprus banking system collapsed. It had too much debt. Oh, where have we heard that before? What's America at right now? $38 trillion in debt? More debt than anybody? And this is what caused Cyprus to fall, just saying. Cyprus banking system collapsed because of too much debt. Government needed about 10 billion euros for the bailout. The EU and the IMF demanded depositor bail-ins. In other words, they weren't willing. Neither the IMF nor the EU were willing to take that risk. And so they just said, well, sorry, we're going to use that bail-in clause that everybody now has in their banking system. First-time depositors, were used to save a bank. All right, the timeline. March 15th, 2013, the bank's closed, no ATMs available. And you couldn't go in with your app on your phone either and move monies. March 18th, so 3 days later, it was declared a bank holiday and it was extended. On March 28th, so we've gone almost 2 weeks now, the Cyprus bank reopens. Deposits over 100,000 euro already confiscated. So you had nothing that you could do for 2 weeks. How many of you could continue your normal business operations with no access to your banks for 2 weeks? Even if they didn't confiscate your money, how many of you could handle having your bank closed for 2 weeks and have no operations taking place? Capital controls. They cannot move money out of Cyprus. Let me reread that one. Capital controls. In other words, that 52.5% that was still sitting in your account that you couldn't get at, it was just a number on the screen or on your phone, but you couldn't actually touch that money. It also had, as they began to loosen up and let you get some of that out, again, it took 5 to 6 years to get all of it, those capital controls prohibited any money from leaving Cyprus. So that's where it's happened. We're going to jump to question number 7 now. Does FDIC insurance reduce or increase risky bank behavior? As I said, it's about 50-50. I looked up Wells Fargo. They have 55% of their deposits are from insured depositors, so less than 250,000, and 45% are the uninsured depositors. This is the direct quote from Claude. Short answer, FDIC insurance enables banks to take more risk, not less. Depositors stop monitoring. My money is insured, it's not my problem. Academic research shows, studies show the FDIC insured banks take significantly more risk than uninsured institutions. I've highlighted that because I get that question all the time. But Eric, is my money safe with a mutual insurance company? And we're going to talk more at length about that. But notice what it says there, significantly more risk than uninsured institutions. Uninsured institutions have to answer to their depositors. So they don't do the risky stuff that causes failure, period. They keep more reserves on hand, period. That is why they're safer. And it just said that by Claude. I thought that was an interesting comment there. I like what it says there. The perverse results. The safety net, in other words, the FDIC insurance, meant to protect depositors, actually enables banks to gamble with their money, making them a more risky place to save your funds. Okay, number 8. What do banks actually do with customer deposits? Explain how fractional reserve banking or credit creation. See Richard Werner and his works. If none of you have seen or watched the video called The Princes of the Yen, it's in English, it's out on YouTube, watch it. Okay, here's the myth. This is what we've all been taught and this is what we think. Bank takes a $1,000 deposit. It keeps some of it in its vault and it lends the rest out to borrowers. And that your money physically goes to somebody else. The reality, as Dr. Werner's proof, you can find other shorter videos about him explaining this theory, is that bank creates new money every time they create a loan. Your deposit stays on the books as your liability. In other words, that liability isn't wiped out as they lend it to somebody else and then turn that loan into an asset on their bank sheets. That's what they were looking for. Remember, we've already talked through this. So you are owed money and it's here on the ledger as a liability to the bank. And so if when they lent out a portion of that $1,000, that would then become an asset because they've lent money to a borrower out there, and that borrower now has an IOU to the bank, and that IOU to the bank is considered income to the bank. So it's an asset, even though it hasn't been paid yet. And that's what it's saying there. Your deposits stay on the books as a liability. They aren't reduced by the amount that they make with a new loan. Simultaneously, then the bank creates with just a ledger entry the new loan and the new deposit. So the new loan that goes to the borrower and the new deposit that is then in the bank account of the person that borrowed it, because that's how the bank gives you your money, right? They dump it into your account. So they have a new liability and a new asset. That's what they do. They didn't use your money at all to make that loan. Money is created out of thin air through accounting entries. Now, I know we've been told that that's what the Federal Reserve does, and you hear the people that follow Ron Paul scream about the Federal Reserve all the time. But the reality is the banking system is making about 97% of all new money in our economy. That's why even one failure can really disrupt the economy. And it's why SVB, Silicon Valley Bank, was such a risk, because that's where there was millions upon millions upon millions of dollars that were the lifeblood of venture capitalist new companies, right? New startups. And that could hurt our economy. And that's one of the reasons that they were saved. All right, so this is the current reality post 2020. The reserve requirement is now zero. The Federal Reserve eliminated reserve requirements in March of 2020. Okay, the bank can now create unlimited money from deposits, and the only thing that's going to restrict them then is, the kind of borrower they're willing to lend to. No legal limit on credit creation, in other words, lending. Even more leverage. They can do it with zero. Even more risk to the bank. Modern banking works through balance sheet expansion. There's a euphemism for money creation out of nothing. Expansion. Asset equals loan receivable of $100,000. Liability, new deposit in borrower's account, another $100,000. Those are the two entries that get created when somebody borrows money. And your liability doesn't change at all. That's what we were saying earlier. No prior depositor's money is moved. That's what we were saying also. So ChatGPT is also telling us the same thing that Claude was telling us, okay? The bank creates a new deposit at the moment of lending. This supports the credit creation framework. See Dr. Richard Werner. In 2023, when SVB, Signature, and First Republic banks failed with a combined $549 billion in assets, did the FDIC have enough money to cover the losses? 2023 bank failures, FDIC fund adequacy. Short answer, no. The FDIC Deposit Insurance Fund was completely inadequate. The math. The Deposit Insurance Fund had $128 billion. We just saw that. The assets that were at risk were $549 billion. That's a shortfall of 4x of insufficiency. What the FDIC fund had to do, invoke the systemic risk exemption. Thus, they had to declare that these failures threatened the entire financial system. Think about that. 3 of the, 4,000 or 5,000 banks we have in America failed, and that was enough to say that that failure threatened the entire financial system of America. You know what? Go back to my example of the roller rink that failed, right? Can you imagine the federal government saving my little roller rink in Corvallis, Oregon, because my little roller rink threatened the roller rink industry across the entire nation? Absurd, isn't it? Nobody saved my butt. Protect all depositors, even over $250,000. Cost far exceeded the DIF balance. Emergency government intervention, which is what Dodd-Frank was supposed to be there to eliminate, was emergency government intervention. Special assessments on other banks. JP Morgan bought First Republic with government assistance, as I just got through saying. So if the FDIC had stuck to the rules created by Dodd-Frank, $128 billion in fund versus $549 billion in failures, the fund would be completely depleted. Uninsured depositors over $250,000 would face bail-ins. And why they broke the rules? Fear of bank runs nationwide. Oh my gosh, if we don't save Eric's roller rink in Corvallis, Oregon, kids will quit roller skating across the nation. We must save his roller rink. No, they didn't come and do that for me, did they? Nope, I lost it. But if one bank in Silicon Valley is allowed to use bail-ins, guess what that rich retired farmer in Iowa might do? Pull his money out of the banking system too, and that's what they were worried about. Tech industry meltdown, they were worried about that, which again would have really caused a problem in the United States, right? And then I got a real kick out of this one. Not too big to fail, too many to fail simultaneously. And how many banks did that take in 2023? 3. 3 banks. 3 roller rinks in America are struggling. Oh my gosh, the roller skating industry is going to fall apart. We must save it. But 3 banks failing simultaneously meant the federal government had to step in. Without government intervention and breaking their own rules, the Deposit Insurance Fund would have been wiped out in 48 hours. Again, that is a direct quote from Claude. All right, question number 10. As of the latest published date, what is the amount of funds in the FDIC Deposit Insurance Fund? And what are total deposits they cover? What percentage of the total deposits are covered? Deposit Insurance Fund, fourth quarter 2024. I guess that was the latest they could find. The DIF fund is $137.1 billion. So it's up from what it was in 2023. Okay. Insured deposits, about 10.7 trillion. So the Deposit Insurance Fund divided by the insured deposits is 1.28%. All right, the next question, number 11. How many FDIC insured banks have failed in the United States in the past 25 years? How many mutual life insurance companies have failed in the past 100 175 years. That's a fair comparison, right? The last 25 years versus the last 175 years. Again, it's because I get the question all the time, well, how safe is putting my money in an insurance company if I don't have FDIC insurance? So the crisis comparison. The Great Depression, 1929 to 1933. Number of banks that failed, 9,000 banks. Now, think about that for a second in light of what we just saw with the FDIC Deposit Insurance Fund being able to cover, even with the extra $100 billion that they could get from the Treasury, only 2.21? Let's just round it up to 3% of total deposits. What if they had 9,000 bank failures? You saw what happened with just 3. So the mutuals had 0 failures during the Great Depression. Minor note, some small insurers failed, but not the mutuals. So again, they're finding evidence that some insurance companies failed, but not the mutual insurance companies. And once again, I have never in 10 years put a single client into a policy that was a stock-based company. Again, from Claude, crisis comparison, 2008 financial crisis. Banks needed bailouts, dozens. Citibank, B of A, and Wells Fargo. Mutuals needing bailouts, 0. Continued paying dividends. The stock insurers were bailed out. AIG, $182 billion. Hartford, $3.4 billion. Lincoln, $950 million. That's what stock-based insurance companies had to be bailed out. Okay, so the crisis comparison, major mutuals have perfect track records spanning the Civil War, 2 World Wars, the Great Depression, and the 2008 crisis. Not one needed a bailout, not one failed. So for those of you that ask me that question, is it safe to put my money with a mutual company? Yeah. Okay, question number 12. Could it be argued that major differences between the financial institutions that needed to be bailed out and those that didn't is their organizational structure? In other words, stock-based versus mutual companies. The first answer comes from Claude. Mutual companies, no bailouts needed. Who they serve? Policy holders. That is different than a stock holder, a policy holders. And they are also the owners and the customers. So those two are combined. Ownership in the company and customer are combined. So those interests are not divorced as they are in the stock world. Okay? The behavior equals conservative, low leverage ratios. Bottom line, yes, the fundamental difference is organizational structure. Stock companies serve shareholders, they take risk, and they needed $1 trillion in bailouts. Mutual companies serve policyholders, they stay conservative, and they needed 0 in bailouts. The 2008 crisis was a perfect natural experiment proving that ownership structure determines behavior, and behavior determines survival. When the owners are the customers, as I said, those two are together in a mutual company, the companies act conservatively. When the owners are Wall Street and investors in a stock company, the companies gamble, and that gamble hurts the policyholders. So that's the issue there. Stock insurance, the stock structure plus the profit maximization equals bailouts. With the mutual structure, the policyholder protection is the most important, and therefore it provides stability. Okay. Question number 13. Explain the fiduciary responsibility of executives and to whom are both stock-based and mutual companies beholden. How this affects decisions. And this is the question that the executives at a mutual company are asking themselves. Will this protect our policyholders for the next 50 years? Again, I'm not arguing that banks aren't needed. What I'm saying is if you need checking functions, a checking account function, then use a bank, right? You're moving money in, you're moving it out. That's fine. We're talking about a safe storage, like your savings account, like your CD account. That's what I'm talking about here, instead of using a bank. And again, the mentality of the executives at a mutual company is, will this protect the policy holder for the next 50 years? All right, here's the last question, and this is probably the best one. Compare one-time $1 million deposit over the past 25 years in 3 different locations. A bank CD earning 4%, a mutual insurance policy earning 5.75%, because that's what I'm making with mine, the actual Dow Jones year by year. For the last 25 years, as we've said a number of times today, the mentality at a mutual company is a 25 to 50 year horizon. That's why I chose that, okay? If you had to choose which storage facility wins, again, not checking account, not investment. We're talking storage facility of your money. But notice I'm pitting it against what we always get told. Oh, well, the Dow Jones did 9%, or I've got a mutual fund that does 11%. Okay, well, watch what happens here. Okay, here we go. Starting 25 years ago, in the year 2000, That first year, you may recall, because of what happened that happened in 9/11, we had a negative 6.8%. So your million has dropped from $1 million to 940,000. Whereas your bank CD went up by 4%, so it's at $1,030,000, and your whole life insurance went up by 5.75, so you have $1,057,500. In 2001, again, the Dow went down by 7%, and in 2002, the Dow went down by 16%, and in 2003, we finally got a huge rebound, but you'll note that even with that jump in 2003, your million is still only worth $916,000, okay? All right, let's move to the next 5 years. So 2006 to 2010, we had a negative, as we know, in 2008 of negative 33.84. So notice here, the Dow had taken your million, and you were now up to $1,172,000. But and I think it was just a handful of months, the Dow dropped by 33.84%, taking your almost 1.2 million down to $770,000. Okay, whereas your boring investment of the CD and the whole life are still just trudging right along. 2011 to 2015, in just 15 years. 2016 to 2020, again, at the end of that 2020, you've got 2.7 million in your brokerage account. You've got 1.8 million in the CD, so it's fine. The brokerage account is finally beating the CD, and your whole life is at $3.2 million. Between the last 4 years, 2021 to 2024, again, all good positive years for everybody there. Your brokerage account is now at $3.8 million. Your CD balance is at $2.1 million, and your whole life insurance has grown to $4 million. I want to make a comment there. Keep in mind, that number is the cash value that you have in your account. Your death benefit after 25 years is still going to be 2 to 3x more than your cash value. So your death benefit's probably going to be somewhere between $8 and $12 million if you were to pass away after those 25 years. So keep that in mind too. Okay, critical observations. The brokerage, that nightmare scenario. I'm liking Claude. They throw in these words that are so cool. The nightmare scenario, 2000 to 2002 crash. Between 2020 and 2022, you would have lost 27% of your investment. And that was due to 9/11. How many of you could have stopped 9/11 and the consequences thereof to the stock market? Nobody, okay? And you lost it. And then what happened in 2008? We lost 34%, whammo! It was like 3 months, if I recall correctly, which is a very short period of time in 2008. Here's my question. If you had chosen to retire in 1999, or you had chosen to retire in 2007, what could you have done to recuperate? Now, if you're a 40-year-old and you've got $1 million sitting out there, and that happens in 2000, in 2000 you're 40 years old, or in 2007 you're 40 years old, you've still got 25 more years to recuperate that. And remember, it took from 2000, that's the next thing that it's saying there, financially it took till 2012 to recover from those two events. All right. So if you're 70 and you retire and you hit that in the year 2000, you're not going to get that money back until 2012. If you retired at age 70, now you're 82. What happened to what you had planned to do during retirement between 70 and 82? So again, this is not an investment. This is a storage unit. But because it comes with such a huge death benefit compared to the amount of money you've invested in your savings account, in the early years, if something happens, it's a huge windfall that will take up the slack for the lacking years that you were not around on this planet to continue investing in the primary thing you do, which is your business. Okay? So that's what I'm saying here. This is the best place to save money in a safe, secure environment. So let me recap quickly what we've talked about. You put your money in a bank, they own it. You put your money in a mutual company, you own it, okay? You own that asset. You have legal rights to get at that asset. The banks have incentives to do risky things and fail. And when they do, the FDIC only has about 1.27% of that money available. If they get the other 100 billion, which they would, because they have a line of credit, you're now talking, 2.3% or somewhere around there, if I remember correctly from what we just got through talking about. Even if it was 3%, it's nothing. And with only 3 banks failing, They still couldn't do it. So yes, you need to take a good chunk of your money when you're young and invest it in things that grow faster than a high cash value insurance policy. But at the same time, you should be squirreling away a percentage of that toward your retirement so that when you are ready to retire, the ups and downs of the Dow, 2000 to 2003, the crash in 2008, we'll have another one, right? It doesn't wipe you out. It doesn't decimate you, because who wants to put at risk their retirement and retiring just before 2000 or retiring just before 2008? So please get a hold of me. We can talk through this. Every one of these policies is created to fit your needs, not mine. I build these policies for you and your needs. So get a hold of me. I'd love to help you out. There's my phone number. There's my email. Get a hold of me. Let me help you. Thanks.